Hello everybody, I'm the Boss Hog and this is this week's version of stocks I've bought. Not quite as epic as last week, but still a significant amount of movement, both selling, buying, and actually a pretty impressive dividend week, mainly from the arrival of a special dividend. So let's walk through it. Okay, so in terms of the approach this week, we continue to work towards simplifying our portfolio, which really means reducing our holdings. As a reminder, at my highest I had 76 holdings. It was just, I couldn't keep on top of it, honestly. It's too many for one person, in my opinion, or at least this person. Probably I'm trying to get to maybe 40, so I might be slightly ambitious, but that's at least the target for now, maybe 45, but definitely working toward that. Plan to average up into quality companies, specifically in kind of the recreational leisure companies that I think are going to have a stellar next 6 to 12 months. So I'm pretty good on a lot of those kind of companies already, but I have no problem averaging up because I think they're going to do really well. I am taking a balanced approach to risk. If you saw my video last week, you'll know that I switched a lot of things into higher risk and higher growth areas, especially trying to take advantage of the NASDAQ wobbles that were going on there. But I realized I need to take a balanced approach, and I think actually that I'm doing that by buying some better utilities that I didn't previously have in my portfolio. And also, yeah, I mean, this is more of the same, really. So more aggressive, less conservative, and higher growth. When I first started, I was expecting like a 4.5% dividend yield. Got that down to like 3.1%, and now instead focusing on a lot of growth stocks. So not neglecting dividend, I still think that's an important thing. But I think because I have such a long time horizon, I can focus on capital growth and take some risk on that as well. So that's the approach we're taking this week. All right, so what actually happened this week? So as I already touched on, we sold out 12 positions and we opened 5 new positions, so net reduction of 7. That leaves me with 50 companies, down from 57 last week. That is across 4 portfolios, so that's an ISA for my wife and myself, and then 2 non-ISA accounts. And for anyone who doesn't know, an ISA is just a tax-efficient wrapper, so there's no dividend tax or capital gains tax on anything within an ISA, and you're allowed to put up to £20,000 per person per year into it. So that's pretty nice scheme. We also sold out a £4,500 worth of stock position, so that's about 10% of our portfolio. So although it wasn't quite as epic as last week in terms of that change, still pretty big number. I'm still kind of actively managing things at the moment and trying to get it really in a good state moving forward. We bought 5.8 thousand, so we reinvested that 4,500 into sold stock above. £800 new capital, so continuing to meet that objective, which is £400 times 2, so £400 into each ISA. Roughly works out at 400 times 52, roughly gives 20,000 with a little bit spare, so hence the number there. We also got £300 worth of dividends this week, so pretty stellar week. That's not that's not normal, unfortunately, but there is a special dividend in there which we'll touch on shortly. And lastly, there was some residual capital from last week, so we also added that as well. Hence the reconciliation there. So yeah, bought 5.8 thousand worth of stock. All right, so we're going to start with the stocks I sold first of all. We sold out 50% of our Carnival holding. It's the only one that I didn't completely sell out of. But it's important to know that I had the Carnival holding in both my wife's ISA and then my personal invest account, so the non-ISA account. I don't really like this. It's something I did with about 5 companies when I first started. It just is a faff. I don't really like duplication. Decided to do some profit taking on my wife's side of things, put it into, I think it was Broadcom that money went into, maybe BMY as well. But the rest of these completely sold out of, and we sold half of our Carnival stock, took some profit basically on the recent run up, and I'm fine with that approach. So if I just zoom through these, you'll see a fair few minuses from the REITs. Again, I just kind of wanted to be out of REITs. If interest rates go up, then they'll be problematic. I think they're a bit defensive. They were fully priced when you buy REITs. Like, there's no complexity really in a REIT. They're very simple business models to understand, and everyone understands them. So they tend to be reasonably accurately priced, if not slightly expensive, especially in a low interest rate environment, just because that's so advantageous. So you'll see a few of these that I got out of. If I just scroll down this list super quickly, so Care Trust REIT, again, I took a small loss here. I'm fine. Carnival was a big winner. I've already touched on it, so I won't go further. Devro is a maker of sausages. I'm not really quite sure how I found it or how I got into it. It had a little run up. I didn't really know much about the business, and I just decided to exit it. But I'm sure it's a fine business, so yeah, I took a little bit of money there. Duke Energy was an American utility company. Didn't really have an interest in, and again took a small loss. Duke Realty, another REIT, decided to take a small loss. Equinix, I really overpaid for. It's a data center REIT. I wasn't sure between Equinix, DLR, and CyrusOne. I still have CyrusOne and DLR. I can't decide which one I prefer. But Equinix, it isn't going to be core. I only had like 1/5 of the share because the shares are so expensive. So I sold out again for a loss. Medical Properties Trust, another REIT, decided to get out of. Realty Income is one of those monthly dividend stocks that some people like, and maybe one day that will be a return to me. When I'm relying on dividends as income, it's a great thing to have, but not right now. It's not needed. Segro is a UK-based REIT, just a standard REIT, not data center. Got out of that as well. Store Capital, more REITs. Tritac Big Box is it also a UK REIT? Originally I was going to keep this, but I sort of looked at it and felt like I got in a very timely, very well. So I bought in early December just before two big bits of news landed. One about an acquisition and one about just far superior numbers than what analysts are expecting. So I say that, there aren't many surprises with REITs. Actually, with this, there was. So I sold out. I decided to take my money. I don't think it's going to do a huge amount, but actually, it's a fine REIT, to be honest with you, and I prefer it to Segro. I think it's a better price than just a bigger, better company. It reminds me a lot of PSA, if anyone has that from an American perspective. So yeah, I just decided to exit it. I had a lot of capital tied up in it, and I didn't feel like it was going to move very fast. So hence why I got out of Tritac's Big Box. And then last was Vistry, a very small stake here. When I first, this was one of those situations where I bought Vistry and Redrow, so two UK house builders. Couldn't decide which one, and decided to instead bet on Redrow. So decided to get rid of Vistry as being surplus to requirements. So that's all the stocks I took here. And yeah, and honestly, I'm happy with it. I think the only one I slightly regret maybe is Carnival, and maybe also Big Box. But like I said, I was fine to take the profit there. The reason why I guess I might slightly regret Carnival is because, like originally I wanted to hold this for a long period of time. And to be honest, if it does dip, I may well add to my 40 shares that I've got on my non-ISA account. So I have a few recovery plays on my non-ISA account. The reason for that is because in the UK, the capital gains tax before it starts is quite high. It's £12,000, 12,300 I think, but over 12 grand, and I'm just not the kind. I haven't got enough money yet to even make that consideration. So, putting stuff in an ISA makes sense. But for me, because they're just capital plays, effectively capital growth plays, I'm never going to be making 12 grand in a single year to qualify for capital gains tax. So I'll put them there. If in the future, when I decide to sell them, I'll basically put it across to my ISA, or maybe just reinvest in something else. So that's the approach I'm taking basically. So if I'm going to be adding Carnival in the future, it'll be outside of the tax wrapper rather than inside of it. So that's the argument. Okay, so that's everything I sold. Let's go on to what I bought. Oh, and sorry, before I do, again, so we sold out for 4,500. Total profit, net profit across all of them, 223 quid. So about 5%. I'm fine with that for a 4-month turnaround. It's pretty solid. All right, now the fun stuff. So the stocks I bought, we just go down this list fairly quickly. We'll start with the new positions first of all. So Apple, now it's interesting with Apple. I'm not really a user of Apple myself. It's far too trendy for me. But under 120 I think is actually a good entry point. I'm fine getting in. Again, I saw the numbers a month or so ago when they published. They're fantastic numbers. It's difficult to argue with success really, and I just felt it was a good entry point. So, and I may well add to this position. It's about 1.3% of my portfolio at the moment. It's up very modestly, made £7 profit so far. And yeah, happy to get in there at the average price there, converted back to sterling of £86. Roughly speaking, that's about $119, something like that. I think it's just under 119. So I was literally adding a share sort of every dollar it dropped, and then I added a couple at 117 and 118. So I was reasonably happy with the buying of Apple there. I think I timed it quite well. Other companies that we opened up was Sentiment. So this is I touched on the fact that I'm sort of buying some hedging or safe investments to counteract some of the work I've been doing, putting it into high growth stocks. Sentiment is basically one of those. It's a gold miner. Its share price has gone down 50% over the last year, mainly off the back of the reducing price of gold. But it pays a pretty solid dividend. If nothing else, I'll just treat it as a 6% bond yield. I don't think it's going to fall much further. I think the sort of pound feels like a floor, or at least around about there. And I'm just going to gradually build up my stake basically as a bit of a hedge. I hear you should have sort of 5% in gold. That seems quite high to me, to be perfectly honest. But again, I'm quite new. I'm going to see how I feel. But yeah, I'm going to sort of add, £50 here, £100 there, just build up that stake. But I think I'm fine with it as a business anyway. This is the one I'm most excited about. I discovered this almost by accident. This is probably the third time where I discovered a stock that I just completely fell in love with. So the first one was Huntington Bank shares, US Bank, HBAN is the ticker. Found that in December, got in, was really excited by the acquisition. It's been one of my best performers. Then I had Hollywood Bowl, which is a UK leisure centre bowling alley, and does like dining and stuff. It's got that retro feel to it. Again, I love the brand, love the numbers, etc. And Games Workshop was very similar for me. Like I knew of Warhammer 40k. I've played a computer game of it. Some friends used to play it when I was at school, etc. But and actually, I do sometimes watch lore videos on YouTube, so I'm sort of broadly familiar with it. But what I wasn't aware of was that this is the second best performing company on the FTSE 250. It's up over 1,800% in 5 years. The new CEO arrived, basically ripped up the order processing, changed the way that the IP was managed, changed the way that units were sold, and how suppliers were managed, and etc. And it's just really done a fantastic job. It's one of those little companies that you don't really suspect that it's not such a little company, and it is one of the largest companies now on the FTSE 250. My suspicion is that by the end of next year, it's actually going to be a FTSE 100 company. It only needs to grow about less than 20% before it gets there, and I've got a price target on this of about plus 30% on what I've paid for it over the next couple of years. So I'm really bullish on this. The numbers are honestly brilliant, and I'm really pleased also where I bought it. I could have been slightly more patient, but I averaged down when it was having a dip between about £100 and £90. So my buy price is about 95 and a bit. So yeah, I could have timed it perfect, but I was basically averaging into it. The reason for the pullback is it's done really well during lockdown, and the argument was that as sort of basement dwelling nerds come out of COVID lockdown, that suddenly it's going to no longer be popular. But I just don't really agree with that. Like, I think it's gained a lot of customers during lockdown. It's there's a streaming series that's being worked on called Eisenhorn about an Inquisitor, so one of the casts, I suppose, in the Warhammer universe, and I just think it's going to be coming to more places. I'm sort of really bullish on the performance. It's an incredibly well managed company. It's really just beautiful numbers, and hence the thumbnail. So from the Emperor of Man there. So that was good fun putting that together. So yeah, great company. I went in reasonably big on this, sort of about 2% and a bit of my portfolio now. And as you can see there, the average price. Oh, sorry, I did actually buy a couple of extra shares, so the average price has been nudged up to 96.90. But again, to me, this is like within 3 years, I'm wanting this to get up to about £130, so something like that. It pays a modest dividend as well, so I'm fine with that. If I get that performance, I'll be delighted, and it'll be a FTSE 100 company. So Pets at Home, I considered buying 3 shares basically. It's between Games Workshop, Pets at Home, and the next company we'll get to in a sec. And originally I bought 1 share in each. And the reason why sometimes I buy 1 share is because although I have a watch list, when I'm getting really serious about buying a company, I'll buy 1 share so it's in my portfolio. I can see it moving. I can kind of see if the time is right to sort of make a bigger acquisition. So I got 1 share in Pets at Home. This is one of those stocks that's also done fantastically well during lockdown. Pets at Home is counted as an essential service, so all of its shops have remained open, and people with not much else to do have been spoiling their pets effectively. So it's been doing really great. It's run up quite a lot, and I'm considering buying it on any weakness basically. So I'm watching it quite closely in my portfolio, and all it's done is rise another 7% since I bought it. So it looks very good, and people are very emotional about their animals. I have a pet hedgehog, He's actually beside me at the moment, and yeah, so I totally get it. I think it's a cool business, and we monitor it closely. Now, next one is quite a risky one, to be honest, and that's Saga. They do sort of products for old people, I think over 50s, if memory serves. So whether you think that's old or not, I don't know. But I mean, it's had a horrible couple of years, honestly. It sort of lost the plot as a business. There are some exciting developments. You know, it does seem to be getting on top of its insurance numbers, where it kind of dropped the ball. Bit of a problem for such a business. They do have 2 new cruise ships that are about to enter service. Obviously, they've been slightly delayed because of COVID, but that's cool. But the thing is this is really still an insurance business, and like it's got real, like it's a competitive industry in the UK. I mentioned already that there's quite a few good UK insurers in other videos, and at the moment, Saga just aren't really competing. So they do have that brand. I think it's a well-known brand, even for people who aren't 50 plus. But it's had a difficult few years for sure. So I also bought 1 share in this to monitor. And whereas Pets at Home went up 7%, this went down 7%. But I do love a good turnaround story. You know, I'm in Royce for a great buy-in price. I love turnarounds. I think they're exciting. Whether this is that turnaround opportunity, I'm not sure. It's pretty spicy, but I am keeping an eye on it just to see if there is a kind of price that's too good to be true. But I haven't done any detailed due diligence yet, so we'll see how that goes. Other shares, I'm just going to move you a little bit closer. Come to me. So let's sort this out. So Aviva, basically I sold out of Legal & General. I decided that although Legal & General is currently a better business, it is, and it pays a better dividend as well, like 6%. Aviva has got a new CEO. They're restructuring. They're getting rid of non-core assets to focus on a couple of key markets, and the market's been very impressed with their updates. I think it's a solid company. I don't think it's a terrible company. It's not as good as Legal & General, but I think it's kind of on the mend. So whereas like I'm nervous about putting too much money into Saga, I'm not nervous at all about investing into Aviva. I think it's a fine company. Bristol Myers, I think the stock is honestly hugely undervalued at sort of $61, I think it's at the moment. I continue to increase my stake here, and you can kind of see actually that I've added 13 shares to what was previously 27. So a relatively sizable increase in my holding here. And again, I'm happy to do it. Broadcom was something I went big in last week, where I added sort of a lot more shares. I did add another 2.3 on a fairly good price this time, and gradually averaging down basically. So pleased how that's going. I think my average is currently $4, so I'm about break even, and it's my largest holding as well. So I added 2.3 shares, giving me a smidge under 12. CACI International, I wish I'd added more because they announced a buyback program. This company doesn't pay dividends. It's very clear about it on their website. It basically says, we believe we can use the capital better to grow our business. But there is another way you can reward shareholders, and that is by share buybacks. This was quite a chunky share buyback as well. It was $500 million on a market cap business of $6.5 billion. So that's pretty sizable, and everyone was very happy. And I felt like actually it rose to $240. That's what I originally got entered into, and I've gradually been averaging down, so I'm now up a couple of percent on this stock. I think it's a really nice blend between an IT company and a military company. It does a lot of kind of cyber advice and governmental contracts as well, so I think it's a nice mix. We've already covered sentiment, so I won't waste more time on it. CyrusOne, a data center REIT, so I have been averaging down into this. Again, I've paid quite a chunk. Games Workshop Group, we've already touched on. Again, yeah, so I did average up for my last 2 shares that I bought. I think it was like 98 something, but I just wanted to have a more sizable stake, and I'm pretty sure it's going to rise above £100. So again, I wanted to build up that stake before it went. That was kind of my strategy as well this week, like both with Games Workshop and the next one, Hollywood Bowl. I wanted to buy, so I started buying Games Workshop on Monday and just added to it during the week. Hollywood Bowl, to be honest, I saw it go up to 250p, and I was like, it's a little bit expensive, I probably won't be buying this week. And then it had a dip where it went down to like 239, and I timed this one really well. Super happy. I basically got perfect. 239, picked up 100 more shares. It does increase my average to over £2 now. I think we're currently at 209. The plan here is to get to 1,000 shares at less than 240, so that's really the focus at the moment. To me, this is going to get to 400, 420 over the next few years, and that's my guide. The reason why I'm owning the stock. Again, I just really love the business. Lockheed Martin. So I did have 0.08 shares of Lockheed Martin. The plan here was to basically put all of my dividends in my personal ISA into LMT. I just think it's undervalued, and I wanted a defensive defense stock. But I did also add some capital as 3.2 shares. Again, I just think it's undervalued, so I'm happy to build a position in it, and I will be funneling my dividends into that. National Grid. Now, I really like National Grid. I added another 26 to what was already 100, bringing my total to 126. It's got fantastic yield. It's a very safe company. It does even have a slight excitement to it in that it has an American arm, which is slightly less regulated, but only slightly. This is just one of those defensive stocks that I wanted to balance out my buying of IT stocks basically and tech stocks. But I really like it. I think it's a great entry price that I've got at 8.34, and yeah, I'm super happy with that. Pets Home we've already covered. Rio Tinto we added us to just very slightly basically. I'm averaging down. It's had a little bit of a dip. I bought it originally once it was ex-divvy and it sort of went down 9%. Just went down slightly further on sort of a strong pound and basically an unloved mining sector at the moment. So not a huge additional buy, but happy to do so. Rolls-Royce here, I added another 90 odd shares to what was previously 410, 413 I guess. Here the plan is basically complete now. I wanted this stake to average out to just over £1. That is my average buy price now. I think it's £1 and 2p off memory. And I'm going to sit on it and see what the next year looks like for Rolls-Royce. It should obviously benefit from the rebound in aviation. It's got some really great IP in the nuclear space and also the space. But yeah, it's got some cool IP, but it's just had a meltdown for the last couple of years. I mean, shares prices down almost 90%. It does seem like it's hit a floor, and this is kind of like where I got into originally because it's just too good to not buy. A sort of 93p was my original buy-in. I've just been averaging up slightly just to back a turnaround play. So I'll be watching this quite closely. At the moment, it's also outside of my ISA, and I count this as speculative, so I can't put too much money into it because I have a self-imposed maximum of 5% of my portfolio for speculative investments. Rolls-Royce is obviously a FTSE 100 company, but it's just so... it's not a million miles away from bankruptcy at the moment, so it belongs in the speculative pot until it gets better. Saga we've already touched on, so I won't do further. SSE is a UK-based utility company. We added about 20%, about 25% to our holdings, so we were at previously 40, now we're 51.4. Again, this is fairly similar to National Grid. I actually slightly prefer National Grid, but SSE also has got a beaten up share price recently. It's slid for no real reason from my perspective. The numbers are okay. Nothing stellar, but again, it's like a 5% and a bit yield, and I'm hopeful for some capital growth as well. Unilever. So this is so I originally entered into Unilever with one share. I don't know, 6 to 8 weeks ago at like 42.70, I think. So and then it obviously had this big meltdown, and I gradually just sort of bought downwards, and now I'm buying as it goes back up as well, and sort of meeting halfway in the middle. I think anything under about 40 quid is okay. I think now my average buy price is about 39.30, something like that. And these shares were bought here, you can see at 38.76. So this was, I guess I could have timed it slightly better. It has definitely been lower. I have bought shares lower than this, but again, I kind of wanted to build a defensive position. Unilever is one of those companies that's quite frustrating to watch because the strategy and everything they say is correct, in my opinion. But for the last 5 years, they've just not been able to execute it. And we'll see. Right now I'm treating it as a defensive stock. I do prefer National Grid and even SSE, and I'll probably done here building my stake. Like now my buy price and the current share price is so close, there's no point in me averaging further, and I'm probably going to limit my exposure here. This is this is close to a 3% holding, slightly under, but I have no intention of adding to my Unilever stake anymore. But I'm okay with it. It's an okay company. And that's everything I bought then, basically. So overall, that's 5.8k, and they've been added into my either existing holdings for most of them or the 5 new ones there as well. So that's everything I bought. But let's have a look at the dividends this week because they were sizable. All right, so dividends. So here it is. So I got a special disc Special dividend from Tesco. They sold an Asian business for, I think it was 7.5 billion. They used 2.5 billion to pay off a pension deficit and effectively didn't know what to do with the other five, so they returned it to shareholders. So that's very cool. So I got near £300 dividends. All of it went into Lockheed Martin to help build up that stake. Now, in fairness, this is a one-off, and after this was paid, or after the record date that you have to hold shares on, I actually decided to exit Tesco as part of the rejig I was doing last week. So I had a sizable stake, but decided that although I think Tesco is slightly undervalued, I think I've already got preferred defensive stocks, and I wanted to redeploy that money elsewhere. So that was the rationale there. As a result of that, basically all the companies here have actually been sold out of. If I just scroll down these super quickly, so Tesco I've already covered. Greencoat is a UK investment fund focusing on wind farms. It has a stated objective for 5% yield and modest capital growth, if any. That's for the investment proposal. It trades at about 1.2 its asset value. People like it. It's a fine fund, but again, I just decided I wanted something a little bit more exciting. Shaw Communications is one of those US utilities companies didn't really know anything about and bought it in the early days and wanted to get rid of it. Duke Realty, very similar. Visa I decided to get rid of because, if I'm honest, I'm probably slightly overpaid. It was just fell back. But really, I'm not sure what the payments world is going to look like in the future. Like, I'm not sure if it's going to be Visa and MasterCard. Don't know if it's going to be like PayPal or Square. Don't know if it's going to be like JP Morgan and other banks getting in on it. Maybe it'll be nobody and somebody new. Maybe it'll be like a blockchain kind of thing. And I guess I just didn't really want exposure to a sector I don't really know much about. I think it's okay to be humble and admit that, to be honest. It's one of those things I probably learned over the last 4 months. Like, I've got no idea about payment space. I didn't really want to be a part of it, and I only had a few shares in Visa anyway, so I just decided to exit Visa. I mean, technically a tech stock, so you'd think I might have been interested, but I didn't want it. Enbridge is a Canadian pipeline infrastructure type company. Here, I think it's an okay company. I decided to sell out of it though because I have both Kinder Morgan and Energy Transfer. I like Kinder Morgan in the long term slightly more than Energy Transfer, but I like Energy Transfer slightly more in the medium term. KMI has got quite a lot of debt, but it's also used that debt to build up a pretty sizable network, and I'm hopeful that I'm going to have like a multi-bagger. Kind of couple of 100% return on actually both of them, but especially KMI. I'm really hoping that now that it's kind of built itself there, it'll pay down its debt and then start really throwing off cash. So that's really good. And First Energy, fairly similar. I actually didn't mind this company, but I didn't really know much about it. Sort of gradually unwinding my utilities positions in the States. Partly that's because one of the main reasons to hold utilities companies is a dividend, but if it's in America, I get 15% tax on it. So there's no reason for me to have it. I'd rather have a UK listed one in most instances, not have to pay the dividend. And to be honest, UK dividends tend to be slightly higher anyway. So it's only the very rare exceptions like AT&T, where the dividend is just so high it will outperform UK ones even after the divvy tax. But again, I think it's just one of those things. So this was all my dividends this week. All of it get put into LMT, and that's everything. So still a lot of movement this week. Not quite as exciting as last week, but hopefully you found that interesting. If you like any of these companies, let me know. If you disagree with any of my actions, I'm curious as well. If you enjoyed this, please like, subscribe, and all that other good stuff. Thank you for joining me, everyone. Bye for now.